Good morning, Linda. How is this Tuesday treating you?
It's great. How about you, Matthew?
It's better than yesterday. Tax day is done, which means either the homework got done or it's too late. So,
Yeah,
as a true vision of the world, now we can be focused between now and December 31st, right?
exactly. Start to think about what you need to do to move forward towards 2019. Really, the planning should start. But
Yeah, actually, I'm thinking more about QuickBooks Connect coming up. So,
oh yeah, let's do that.
I think that'll be a little bit more fun.
Yeah,
But I digress. You found a good question. What is this? This one's about the equity section, I believe, right?
yeah. I mean, I answered a couple of questions before that, and then he just wanted to know what's an equity account. What exactly is that on the balance sheet?
Okay. Um, so when we're talking with newer clients, I tend to discuss how a profit. I know the specific questions about the equity section, but the kind of the bigger description I always like to give is if you look at a profit and loss, or if you look at how your business is doing during a given year, a period of time, you're going to see that information on your profit and loss. So how much money you brought in, how much you spent out in expenses, and you're either going to have a net income or a net loss for the given period, right?
Mm-hmm.
At the end of that period, i.e. December 31st, you need to do a reset on that card. Well, the way that gets reset is all of that information gets transferred over to your balance sheet. And it's actually down in the equity section of the balance sheet. So net income, boom, right here. Your balance sheet is like your long-term scorecard. So if you have multiple years of profitability, you're going to notice that your retained earnings will actually be a higher number, will be increased because you're going to retain more of those earnings into your business. If you have years of bad years, you're going to go into a negative retained earnings. So the balance sheet overall, is the equation is your assets are equal to your liabilities and your equity, right?
Mm-hmm.
So assets being anything that is cash, they say like cash liquid. In other words, it's convertible pretty easily or quickly. So your bank accounts, your accounts receivable, your inventory, not your bill, your finished inventory, I should say. And then you would have, of course, your assets and accumulated depreciation. But then the offset side of that is your liabilities. So any credit cards, or your credit card balances, and the accounts payables, money you owe out. And then the final part of it is your equity section. And the equity section can be one of the most complicated because it is kind of like, it feels like a whole bunch of sumarial accounts, right? If as a business owner, if you invest money into your company throughout the year, you're going to see, as we have it here, we put in investments. As you were talking about earlier, depending on your entity type, right?
Right.
There's
So you get to
different
be
words for
careful.
this.
Right.
But in general, you're going to have any monies that you invested as minus any monies you took out, distributions. Maybe you went to the ATM and did some withdrawals or something. You need to wash those against each other and against the retained earnings of the equity section. And then you would also have your net income within that area or net loss for the year. The last part of it, which was kind of the first question that was being asked, you should never actually have opening balance equity in here.
Right.
The opening balance equity is like when you're first setting up a bank account and you had it beginning balance. That actually should be journalized into the proper accounts on the balance sheet, and the opening balance equity would never be there.
Right. That basically balance sheet. So it balances out. So by the time you're done entering that big journal entry of your opening balances, it just goes to zero so that you don't need the opening balance equity account anymore.
Yeah.
It's just part of the setup. It's kind of a QuickBooks made up account, really. But people use it all the time because a lot of times it defaults to that. If you like, well, when you open, connect a bank account for the first time, which is what happened here. He connected the bank account and then it throws it into opening balance equity, all the earlier, 90 days worth of transactions, the date, the amount, and you just got to get rid of that transaction.
And the reason for that is if you if you're bringing an account in and you got a checking account and you've already got $6,000 in the account, when you go to start your reconciliations, it has that beginning balance. That money had to come from somewhere.
Right.
So it didn't start from zero unless it did. So that $6,000 would be equity in your business because it's an asset at that point in time, right? So you would journalize it appropriately into the structure of your entity, trying to circle around that carefully, of course, to take it out of opening balance equity and put it into the right accounts. If you had a credit card, that would be a liability. So same concept, even a credit card, you can actually have that impact your opening balance equity just in a negative manner.
Right, because you owe it.
Yep. So hopefully that helped kind of give a good overview of the equity section, including opening balance equity, and answered the question they had, right?
I hope so, because that was nice and detailed, and hopefully they understand it a little bit better because he had trouble finding any real good descriptions of what that is. So hopefully that helped.
Sorry for all the accounting jargon, but this is a question that demands it. So hopefully it helped. And as always, we wish you all a very successful week.
And find us at QB Connect or follow us.
Yes. Bye, guys.
Bye.